We're all right.
Good afternoon, Professor Baudouin.
Good afternoon.
We're going to move topics and talk about rents for a bit, okay?
About
Rents.
rents.
And I want to refer to an article by Robin Baudouin, which you'll find at tab 5 of the compendium. It's entitled "A Tax Policy for a Rent-Rich Economy," dated December 2015, and you recognize this document or this article as being an article you authored?
I do.
And I have a couple questions about this document. If you could go over to compendium page 31. There's some yellow highlighting on page 31 of the compendium. And on top of the yellow highlighting, about 5 lines up from the words "moreover." Now, there's a statement there, thus moving from the current income-based CIT, that's corporate income tax,
Yes.
to an ACE. What's ACE?
It's a form of a corporation tax that's designed to tax rents.
All right, so this article is about how one might tax rents.
Yes, not just in resources, but in all rents in the society.
Okay, so this is a paper you wrote about how to tax rents in the economy, and I'm going to continue reading. Thus, moving from the current income-based corporate income tax to an ACE rent-based corporate income tax would reduce tax revenues by less than 20%, confirming that about 80% of corporate income consists of rents and returns to risks. Even if the risk premium were equal to the risk-free interest rate, rents would still be 40% of corporate income, and presumably that is an underestimate. Do you agree with that statement?
I said it.
Yeah,
I wrote it.
I know you wrote it. I know you stated it, but do you still agree with it?
Yes.
And am I to understand that what you're trying to convey in that paragraph is that part of what is captured by the Crown in corporate income tax is rents?
I'm talking about corporate income per se, not the corporate tax base, but the corporate tax itself is not a tax on rents. But I take your point that some of what the corporate tax applies to would be rents in the corporate sector.
Yes, thank you. And if you could go over to page 33 of the compendium. In the right-hand column, we've got some highlighted text, and you write, of more significance, a rent tax would be very similar to an ideal tax on natural resources, both renewable and non-renewable. And I'm going to stop there. Do you believe that to be a true statement today?
Sorry, I can't see that. I can't find this in there. And where you're.
It's highlighted on the computer screen. If you want to just.
Oh, I see. Yes. Mm-hmm.
You agree with that?
Yes.
You then write, since a rent-based corporate income tax would not selectively target the resource industries, it would not violate the provincial right to levy dedicated resource taxes, period. Indeed, the current corporate income tax already taxes natural resource rents, albeit inefficiently.
Yes.
You agree with that?
Yes.
And so can you provide some guidance for me why it's inefficient and why a rent tax would be better?
Because the corporate tax is not a rent tax. It's the base of the corporate tax is not rents, it's shareholder income. And to the extent that shareholder income includes some rents, you could say that rents are included in the corporate income tax base. But the corporate income taxes, I mean, part of the purpose of this article is prescriptive, is to say, how might we want to design the tax system if we wanted to tax rents? It's not descriptive of what the existing tax system does.
Right. And within this article, I don't see a statement that the government could effectively tax 100% rents, or the the tax would be 100% of rents.
On the contrary, there's a long discussion about why you can't separate rents from returns to risk, and you couldn't tax 100% of rents.
Yeah, that's my point.
Yeah,
my point is, your position is that you can't tax 100% of rents, but what you can do is estimate what the rents are to figure out how much you're collecting, right?
No, there's a statement on page 31 that I just happened to notice in passing that says rents are incredibly difficult to measure. Well, on page 31, last column in the last paragraph in the left-hand column.
Yes. Yeah, they might be difficult, but you can estimate them. You can't measure them precisely because of some of the problems you said, but you can try and estimate what they are and figure out if your rent tax, if you were to implement one, how close it's getting to optimal collection.
Well, you can estimate them, but the accuracy of the estimate wouldn't be very high, given the statement on the next page that a high proportion of corporate profits are returns to risk and not rents. I mean, you know, it's comparable to what we have said in our paper, that you can't separate rents from the return to risk. And that's a constraint on the government being able to tax rents.
Perhaps we should have this document marked as an exhibit in the cause. Apparently it's not in the joint book. The author, as the witness and author, have identified it. I do not have an extra copy to hand up, and my suggestion is we'll do that tomorrow morning, if that's okay.
I'm content. Mr. Marcelo. Okay.
If you could go to.
So we won't mark it now, then we'll mark it tomorrow.
Yes, I
Thank
think it makes more sense just to mark it.
Thank
tomorrow. You. Page 38 of the compendium is an article written by a fellow by the name of Hugh Grant. Are you familiar with this fellow?
I know he exists, but I don't know him personally.
Okay. This is part of trial exhibit 1-0, or it's trial exhibit 1-0005. And I wonder if you could go to page 39 of the compendium. And 5 lines down from the top, from the bottom.
5 lines up?
Five lines. Thank you so kindly. 5 lines up from the bottom on page 39, you will find the following. Economic rent is an important indicator of the potential fiscal benefit which could accrue to the owner of the subsurface rights. Do you agree with that statement?
Yes.
Over on page 40, at the top, very first paragraph, you'll find the statement, the distribution of rents and the landowner's capacity to capture a fair return on the land, therefore, depends
on
it should be on, but just says an, depends an appropriate royalty / taxation regime. If the landowner fails to establish an adequate tax structure, a share of the rents will be captured by the private firm undertaking the investment project in the form of excess profits. Do you agree with that statement?
Yes.
At the bottom of this page, at page 40, the statement is made, assuming a competitive bidding process, the landowner should capture all the expected future rents. Do you agree with that statement?
Not fully.
All right. What is wrong about it?
What's wrong? Well, what's wrong about it is that in a competitive bidding process, the bidding would take into consideration the riskiness of the asset being bid for.
So, is that then a question of what is, if the price of the thing being bid for carries with it a risk, doesn't that affect the price of what is being bid for?
It means that the bidder will not offer, well, that will constrain the price they bid because what they're going to get is a risky outcome.
Right, but the rent is whatever the rent is. The rent is the value of the resource, the natural resource, isn't it?
Yeah, but you don't know, the rent depends upon the price that the resource eventually sells at. You don't know that for certain. So rent is inherently uncertain. And that would be taken into consideration in the bidding process.
It would be taken into consideration, but I had thought that the author of this document, or this that we're looking at, was trying to convey that if you had a properly competitive bidding process, then that would approach exacting a more accurate portion of rents than if you just gave it away or had a set stumpage fee, for example. That's what I thought he was trying to convey. Am I wrong about that?
No, I think you're right. Compared with a stumpage fee, I thought we were talking about a mineral deposit, but okay, stumpage fee.
Well, even if it is mineral deposits, it's the same principle, isn't it?
Yes.
So the only point I thought the author was trying to make is that if you have a competitive bidding process, you have a better chance of collecting a greater portion of rents.
Yes, I mean, of course, it depends what you're bidding on. I mean, if you're bidding on something which entitles you not just to extract the resource, but to process it, then that's going to affect the amount you bid. Or if you're bidding on a stand of timber.
Oh, I see. I see. So your concern then is the bidding process you're referring to might not be, from this author's perspective, confined to bidding on the natural resource itself, but might be bidding on something else.
Right. Yeah. Okay. I mean, in general, I agree with the principle that competitive auctions tend to generate values of things, the value of things being bid on, but it has to be a competitive auction, and it has to be designed in such a way that the thing that's being bid on is the thing that you want to measure the rent of.
And designing a competitive auction is a difficult thing? Oh yeah,
I mean, you have to decide what the object of the auction is. Is it going to be an area of land? How big is the area going to be? Can you bid for more than one contiguous area? No, designing exactly what's being bid for is not an easy matter. And so the design of auctions, it's easy to say a competitive auction yields rents, but designing a competitive auction is not trivial.
And it's also not trivial, I take it, who you invite to the auction. You only invite one person to the auction. You're not going to get that good of a price.
Agreed, yeah.
You then make the point that...
You mean Professor Grant makes the point?
No, I'm moving on to asking you about your opinion. In your opinion, and I actually don't think it's all that controversial, but let's see where we go with this. 100% of all resource rents could not be captured by the Crown, is what you opine.
Yes.
And your view of what Stiglitz and Hutchings has done is to postulate a world, if we can call it that, where 100% rents are captured.
Yes.
Now, I'm going to suggest to you that when they are talking about capturing 100% of the rents, what they are talking about in their reports is identifying 100% of the rents, not trying to actually capture them in real life. And that's why they talk about implicit subsidies. Do you understand that?
Oh, of course, I agree with that.
Right. So their point is that the Crown should capture 100% of rents, and you would agree with that if it could.
You know, that's a normative statement. It would depend on the, you know, should is a normative statement. And I mean, I understand where they're coming from that. If your objective is to get as much rents as possible for the Crown, then you should try and get 100% of the rents. Yes.
Okay. And just I want to reiterate that. So Stiglitz and Hutchings are saying that if we can estimate, or they try and estimate what the rents would be, yes, and they postulate for the judge that if the Crown doesn't capture all of those, they're giving what's called an implicit subsidy. You understand that?
Yes.
And you understand that in their model, Stiglitz and Hutchings model, the user of the resource doesn't pay any more or less with this implicit subsidy. Would you agree with that?
Sorry, I didn't quite understand the question.
Okay. Their model suggests that where the Crown doesn't collect the estimated rents,
yes,
what's happening is that the user, call it the mine company,
yes,
is getting an implicit subsidy.
That's the way they put it, yes.
Right. And so perhaps we can go, and I wanted to try and understand this for myself. So me and Miss Lewis did a couple stick figures. If you'll go to tab 7, and I just want to make sure that we can understand how this implicit or explicit subsidy model that I think Stiglitz and Hutchings are on about kind of made sense to me. So the first one we have is we have a situation where the Crown does not collect all of the rents. And so we start off with the value of the trees being $100. This is down at the bottom. And then we have a forest company paying $40 for a stumpage fee, and it gets no subsidy, and their net cost is $40. Right? The
net cost to the tree producer.
To the forest company.
Forest company, yes.
And so you can see, follow the $40 stumpage fee going up to the right, and it goes into the Crown, and the Crown has $40. The Crown then has a $40 pie.
Okay.
Right? And there we have a little $40 pie there. And then, according to Stiglitz and Hutchings, if you accept their 84%, and I appreciate this is very simplistic. It doesn't deal with I'm trying to capture the essence of their argument or their proposition in their report.
Okay.
You have the fellow getting 84% of $40 or $33.60, even though the value of the asset is $100.
Who's getting the $33.60?
The unhappy looking guy holding up a measly bill. Let's consider them the Anishinaabe.
Okay. Fair enough.
Right. So yes. So that, and if you look on the left-hand side, the Crown is foregoing collecting $60 in resource rents from the trees, but then Stiglitz and Hutchings say, well, that's really just an implicit subsidy. That's kind of how to explain their model, right?
Yeah, I shouldn't be picky, but a $40 stumpage fee is not a fee applying to rents. It's a fee applying to production, but that's a minor point. So.
Okay, thank you for that correction. Now, as you can see, the Crown's implicit subsidy has a real effect on this poor guy at the top of our slide here, who doesn't look too happy with his $33.60. And I'll admit that the slide is a bit pejorative on my part, but it is what it is, right?
Yes, could I just be clear on what this represents? Because the 3360 is a share of the Crown resource revenues. It's not a share of the total rents, right? That's
right. It's just a share. I'm considering in this model the $40 as part of NCRRs.
Okay.
Right. And I'm just trying to follow through how this implicit subsidy idea ends up costing the Anishinaabe.
Okay.
Okay. Let's go to the next slide. Now, in the next slide, we have the same person a little bit happier, dreaming of building some infrastructure on reserve, perhaps. But let's follow through what happens with this one. Again, we start at the bottom and that the value of the trees is $100. And again, I take your point about the stumpage fee being whatever. How would you phrase it? A stumpage what?
It's a charge based on the production
charge
of trees. It's not a charge on the rents.
Right. Okay.
So it's not a charge on the value of the trees. But
okay. So the Crown collects $100 from the forest company, and they receive $100, but this time they say, if we take $100 and the full amount of the value of the trees, the rents from the forest company, that's going to leave the forest company out of business because or not out of business. They might go to Georgia and start cutting logs down in Georgia. So we've got to be competitive. So what they do is they turn around and they give the forest company a $60 subsidy.
Okay.
Now, you would agree with me under that kind of in and out scenario, the Crown gets $100 and gives a $60 subsidy, and the forest company pays $40 for the privilege of cutting the trees. You follow that?
And we were assuming that the subsidy given to the forest company is not treated as a negative NCRR.
Right. What we're going to get to that in a moment but now in this scenario, they have $100 pie. And again, just assuming 84% for a moment, 84% of 100 is $84. And there you have the Anishinaabe stickman dreaming of what he can do with his $84. So he's a fair bit better off if there's no implicit subsidy, but an actual subsidy. And this is what I think Professor Stiglitz and Mr. Hutchings are on about and trying to explain in their model. Is this fair to say that this is what they're trying to communicate?
I think so. I think, if I recall, I think Professor Smart used the term tax expenditure, which is like a subsidy. I think same sort of thing.
Now you raise the point, but where does the $60 come from? And the difference is a difference of opinion, I suppose. Would you understand? I understand Professor Stiglitz and Mr. Hutchings saying, well, the $60 is really nothing more than a policy choice by the Crown to forego rents.
Yes.
And it's okay that the Crown can make those policy choices, but it shouldn't come out of the Anishinaabes share. I think that's their position. Do you understand that to be the case?
I think that's their position.
And is your position different than that? Do you think that the Anishinaabe should be paying for that subsidy?
My position is that I'm not making a normative judgment about what they should or should not get. I'm guided by what I read in the stage 1 decision, the Court of Appeal decision, about what it is that is being shared.
So we can't ask you to be a benevolent dictator just yet, huh?
Well, you could, but my opinion wouldn't be. Why is my opinion any better than anybody else's when it comes to that?
Okay.
Mr. Schachter, at
Yes.
the beginning or end of every witness, we ask about waiving copyright. Should that question be asked?
I think that question should be addressed to probably, I don't know, Miss Lewis. What? If we have to waive copyright, we certainly would. And if there's anyone out there in the universe that wants an NFT of this, I'm willing to sell it. Touché. Touché indeed. I wonder then, Professor, if we could turn to slide 35 of your compendium.
Of the slide deck?
Of the slide. Yes, I said your compendium. I apologize. I meant your slide deck, exhibit 74. And at slide 35, you're talking about the issue of tax avoidance. And you quote from an oil and gas article written by Professor Stiglitz. Remember that?
Yes.
Now, I think your point in bringing this to the judge's attention was that it would be difficult to design a rent tax on oil in Alaska because of tax avoidance and tax evasion. Is that fair?
Yes, I think my point was to suggest that Professor Stiglitz knows all about transfer pricing.
Right.
And the difficulties that it poses for taxing rents.
Right. And so the point that you want to make is that it's not just in respect of oil in Alaska that it's difficult to design a rent tax to capture all the rents, but you can also apply that same reasoning to minerals and trees and
that's right.
Other natural resources in Ontario. Is that correct?
That's right.
But I appreciate that you draw that conclusion, but I note that you did not tell the judge that in the same article, Professor Stiglitz has solutions that mitigate those avoidance and evasion issues, did you?
No, but I would be surprised. That's what we do in our profession.
I'm sorry?
That's what we do in our profession. We identify problems and we propose solutions.
Okay, so...
like in my rent tax article that you referred to.
Now, at the compendium page, tab 10, we have the complete article, and I'm not proposing to go through that and show you paragraph by paragraph where Professor Stiglitz proposes solutions to the problem you posed, unless you think we need to.
No, I'll take your word that he proposes solutions, and that's fine.
Okay, so, and the reason why I'm not going to actually bother going through all the solutions to sort of test them to see, you know, how well they get us to collecting 100% of the rents, is because, and I want to return to Norway on this issue. And do you have any idea why Norway?
I think so.
Why do you think?
Because I was reading another one of my articles that I suspected you might say something about.
About how well Norway taxes rents?
Yes.
Well, I actually had a little bit of a different Norwegian take on this, and it has to do with Blindspor. Do you know what Blindspor is?
No.
Blindspor is Norway, or Norwegian, excuse me, for red herring.
Oh. Okay.
Stiglitz and Hutchings in their reply report at paragraph 26 explain that the values that they report in calculating their rents already account for the fact that in the current taxation regime that they use, there is already avoidance and evading of taxes. You understand that?
I read that and I responded to it.
And I suggest to you that Stiglitz and Hutchings are fairly comparing apples to apples, and that your concern about inability to capture, the difficulty of dealing with avoidance and evasion is in fact a concern that is already addressed by being baked into their model anyways. Would you agree with that?
No, I don't.
Would you agree with me that they opine that it would be baked into their model?
I agree with that.
Thank you, sir. I wonder if we could turn to page 5 of your SIR reply.
Sir, reply to Stiglitz Hutchings or sir, reply to Hutchings?
Yes. Okay, hold on.
Sorry to be legal.
No, that's okay. Okay. No, we don't have to do that. I can skip over that. Well, let's go to slide 47. In your slide 47, you make the point that auctions were used in timber license auctions between 1849 and 1960. I'm looking at 47. The first bullet point. I'm just trying to identify that that's what you said. Do you agree?
Yes.
All right. So am I correct in understanding that the point you're making is that in estimating rents, Stiglitz and Hutchings must be improperly bumping up rents above NCRRs actually taken when it's unwarranted to do so, because auctions have a better chance of collecting more a better portion of the rents. Is that what this criticism is?
No, not exactly. If I might elaborate a wee bit, this section is a section that has to do with the difficulties of taxing resource rents, and there are two elements of this that I think we were trying to capture in the content of this slide. One was that the auctioning was based on bonus stumpage system. It wasn't based on rents. It wasn't, you weren't getting the right to a certain amount of property that you could use as you wish. You were getting the right to cut trees. So it was a auction of it was sort of an auction of stumpage, if you like to think it that way.
Yes.
So, and the reason for that was because that was a way of addressing some of the issues that were perceived to be a problem with auctioning tenure, addressing the issue of tax evasion, of stumpage evasion, and so on. The other point you make, though, is actually a relevant one, that if we're measuring resource rents by stumpage fees, then, and we do the same thing, of course, because it's the only alternative we have, but it is, in some sense, stumpage fees are an overestimate of rents because they don't deduct the cost. They only represent the revenues or the production value of the tree and not the cost of cutting the trees.
So when you make when you explain to the court about the use of auctions in timber, you are not trying to suggest to the court that in calculating rents, Professors Stiglitz and Mr. Hutchings inflated the amounts of rents, are you?
No, we did the same thing. It was the best available measure we had. I mean, the fact is, stumpage is not stumpage fees are not a tax on rents. They're not designed that way.
Well, but you appreciate that Stiglitz and Hutchings did try and value rents.
I agree with you. I mean, I'm not. We did, as I said, we did the same thing. We said let's just treat stumpage fees as NCRRs, and our version of NCRRs is NCRRs should be taxes that the Crown gets from rents. So we use stumpage fees as if they were rents.
Right, but the point I'm trying to understand is Mr. Hutchings and Professor Stiglitz, they actually had two sets of numbers. Yeah. They had one set of numbers for NCRRs and they had a higher number for rents.
Oh, I get your point. Yes, yes.
And I was concerned, and I'm glad that you're correcting this for me. You're not suggesting that what Stiglitz and Hutchings did in determining rents was somehow improper the way they calculated the amount of rents.
No.
Thank you.
Sorry if I left that impression.
You also make comments about the World Trade Organization softwood lumber dispute.
I do.
And what was the purpose of letting the court know about the softwood lumber dispute?
I think the purpose of that was to take issue with the suggestion that the Crown were, to use the words that you used earlier, were implicitly subsidizing the forestry industries by giving artificially low stumpage fees so that they would be more competitive in exporting to the US. That was really the only intention of that. And so that discussion about the softwood lumber dispute was simply to say that that does not constitute evidence that the Crown consciously or explicitly reduced taxation simply to reduce rents.
Well, are we getting into a debate about intent and effect, or what are we getting into here? Or do you know? I mean, maybe it's an unfair to ask.
Yeah, you can interpret it that way. I mean, it's all part and parcel of this sort of suggestion that the Crown, at certain points in their Stiglitz and Hutchings report, and I can't pinpoint where it is at the moment, they've suggested that the Crown had an incentive to calculate less revenues from resources, because if they did so, they would have to pay part of that to the RST National.
Well, whatever their mindset may have been, that incentive did exist. They may not have acted on it, is maybe your point.
That's my point, yes.
Right, but the incentive existed regardless of their mindset. Would you agree with that?
Partly. I mean, this goes, I agree with you in general, but don't forget that in order for the Crown to act on that incentive, they would have had to separate resources in the RST territory from resources elsewhere in Toronto, elsewhere in Ontario.
Or they could have treated everybody the same, and could
right,
they not?
But it would be very costly for them to subsidize lumber companies in the territory if at the same time that entails having to subsidize them everywhere else in Ontario. So
it's a question of how much of your rent you want to leave on the table, I would think. Would you agree with that?
Yes.
Thank you. Going back to
would it be fair, Mr. Schachter, to say that with respect to consideration of incentives, But this is based on an assumption that the Crown thought they had an obligation. See, my worry about this evidence about incentives is, and I believe I asked this question myself, is it's relevant if, I think, but I might be corrected, if the Crown understood they had an obligation.
That is true.
Okay.
Yeah.
I get the point.
So I'm just for an answer that makes sense, a question that makes sense.
Yeah.
I think that should be part of it.
In terms of the softwood lumber dispute, you would agree that the U.S. has appealed that ruling?
Probably. They appeal most rulings.
And you would agree with me that the softwood lumber dispute and the allegations of improper subsidies levied by the United States goes beyond stumpage fees themselves and includes other aspects of alleged subsidies to industry over and above stumpage?
I don't know the details of it, but I'll take your word for it.
Okay. I want to talk briefly about Baumol's cost disease. You're familiar with that concept?
Yes.
Yeah, I thought maybe if I just slid it in there, I wouldn't have to pronounce it properly. It's Baumol's. How's it pronounced?
Well, I've traditionally said Baumol, but
okay.
But it is spelled for Madam Reporter.
Baumol.
Okay. So is it fair to say that you and Professor Smart have differences of opinion on the level of expenses generally after 1945? That's for sure. Yeah, okay, so let me try that again. It's fair to say that you and Mr. Smart have differences of opinion on what expenses are proper than Mr. Stiglitz, Professor Stiglitz and Mr. Hutchings?
That Professor Smart and myself have a difference of opinion with Professor Stiglitz and Mr. Hutchings.
Yes, on expenses after 1945.
Yes.
And I put it to you that Stiglitz and Hutchings' opinion on the inapplicability of the Baumol's cost disease to the natural resource expenses is a reasonable opinion for them to have. Would you agree with that?
I'd have to refresh my memory about what their opinion was, but I can't imagine that being the only reason that I might question the relevance of it is sometimes they restrict their data to years that are fairly recent. And
sorry, my only point is that what the applicability of Baumol's cost disease and the effect of it is a matter of difference of opinion between experts. Would you agree with that?
You mean the existence of the Baumol disease or the size of it?
Its effect on expenses that are properly taken into account after 1945.
I don't think that the Baumol disease addresses which expenses are to be taken into account. It's simply a statement about why we might observe expenses rising relatively rapidly in the public sector.
And the point I was trying to make, and then I apologize for my inarticulate speech, but I'll try again. Stiglitz and Hutchings are of the opinion that they did not, in their calculations, fail to properly account for the effect, if any, of the Baumol's cost disease. You understand that that's their position?
I do, but after 1945, their procedure couldn't possibly have taken account of the Baumol disease.
Well, yeah, they say that it doesn't apply. that's their opinion, that it doesn't apply to their analysis. You understand that? I'm not asking if you agree with it.
I don't, maybe, I don't know. There was no analysis after 1945 of expenses in their data.
They do write about the inapplicability of Baumel's cost disease. You know that?
Yes.
And that's their opinion, that it's inapplicable, and you disagree with it, right?
Yes, but I had thought they were referring to it being inapplicable in our calculations, not in theirs. I may be wrong.
If I would say that their opinion is that they don't think that the judge should take it into account, would that be unfair to you?
No.
And you would want the judge to take it into account, right?
It was one element among many that might explain why expenses were rising after 1945.
Right. But there's a difference of opinion between experts.
Yes.
And each expert's opinion might not be agreed by the other, but Stiglitz and Hutchings' opinion isn't necessarily wrong. It's an opinion that's different than yours, is the point.
I agree.
Thank you. If we could turn to slide 64, please. This is of your slide deck. And then turn all the way over to slide 100, because you've covered this area already.
I was wondering.
Now, slide 100 says risk-adjusted NCRRs. And there's a chart here that says figure constructed using figure 1, page 16, table 7, page 45, Bodway and Smart present value report. You'd agree with me, sir, that the chart that's depicted in page 100 is not in your report?
Yes.
It's something different.
It uses the same data, but it presents it in a slightly different way.
Well, let's take a look at figure 1, page 16.
Which report are we looking at?
We're looking at the Bodway and Smart present value report.
Okay.
So we're going, it's exhibit 61. We're going to go to page 16. And page 16, figure 1 is entitled Figure 1 Present Value of Annual NCRRs. And I have to say that this chart on page 16 looks quite different than the chart on slide 100.
Okay, shall I explain?
Sure.
Yeah. There are a couple of things that make it look different. Well, one thing in particular, you see that large negative in NCRR report figure 1, there's a large negative blip in 1912.
On page 16?
On page 16.
Yes.
And there's a note on the slides on page 100, there's a note that says to make this graph readable, the large negative value from 1912 has been omitted. So we've omitted one observation. And that was simply to make it fit nicely onto the graph that was being done here. But otherwise, the other difference No, I take back what I was going to say. Otherwise, the graph should be the same. Now, you know, bearing in mind that numbers have changed between the time we wrote our original report and the time we prepared these graphs. These graphs, to go to a question you asked earlier on, these are my slides, but I asked Professor Smart to give me a graph of this because he was the person who put the graphs and numbers together.
All right, thank you for that. Whatever is supposed to be depicted on page 100 of your slides, these are present values, not nominal values?
Yes.
And they're present values in each year.
Yes.
So you've taken your data
yes.
from say 1851.
Our NCRRs, yes.
Your NCRRs in 1851, and you've asked yourself the question, if we apply a present value factor, how much money would be owed for the 1851 year? Is that what you've done?
Yes.
And so the lines are supposed to be at least in page 16 of figure 1. And I'm not sure why they're different, but the red dots are the annual figures of PV values at bond rates, not nominal rates, right?
Yes, of risk-adjusted NCRRs, yes.
And would you agree with me that whatever—
Sorry, I just want to make sure I'm looking at the right thing. I'm at on slide 100.
Yeah.
Okay, go ahead. And your question was, did you say the red dots or the red line? Or?
Well, at the top of each and at the bottom of each line, there is a dot.
Representing the
taking
year?
it that the dot represents a year, maybe?
Yes, the red lines connect the dots.
Okay, thank you.
But what the dots are depicting is the level of NCRRs that have already been adjusted through your present value factor.
Yes.
And run through a risk adjustment. Is that right?
Yes.
So the graph would look very different and tell a very different story if one used Mr. Hutchings' NCRR calculations. Would you agree?
Certainly.
And it would also look very different if one did not use a risk-adjusted amount. Would you agree?
Certainly.
And it would even look much more different if one used Stiglitz and Hutchings' preferred 60-40 rate of return.
Yes.
Would you agree that most notably the positive years in the Hutchings NCRRs would have significantly greater weight the longer in the past that NCRR arose? Do you understand the question?
I think so, yes.
So I'm just going to try and make sure I don't know if we're both clear on that. I want to be doubly clear. The dots, because they are so far in the past from 1851, 1852, 1853, the magnitude that the red line would go up or go down is a function of how far in the past
yes.
You are looking at the NCRR.
Yes.
So I'm not sure what this graph really is trying to tell us. It's just a way of demonstrating or showing what your results are. Is that what we're supposed to understand?
No, I can explain it if you want.
Yes.
To explain it, you have to also take account of the blue line. And the blue line is a line that depicts the weight that's given, what risk adjustment does to the NCRR. So as we go from 1850 to 2020, the blue line depicts the proportion of the NCRR that's left after we do the risk adjusting. And this illustrates that the further is something into the future, starting in 1850, the less weight we're going to give it. the reason for putting this in is because it addresses a comment that was made in the reply of Professor Stiglitz and Mr. Hutchings. So what we're trying to show here is that using our NCRRs, one of the characterizing features of our NCRRs is that, as you know, they're negative after the 1960s. But the point is that the process of risk adjustment, and I could say the same thing, by the way, for putting them through the annuity regime, but here we're talking about risk adjustment. Process of risk adjustment says that we're going to attach relatively low weights to things that are going to occur further into the future, i.e. closer to today. So that's what that blue line depicts. And the reason for showing this is simply to say that the use of risk adjusted NCRRs essentially eliminates the consequences of these largely eliminates the consequences of these negative NCRRs in recent years because they were so uncertain.
But you're presenting that as a positive.
Well, it's a positive thing from the point of view of the RST and Anishinaabe. It's a negative thing from the point of view of the Crown.
It's only a positive thing for the Anishinaabe if the amounts are so negative as you say, because if you would use Mr. Hutchings' figures, instead of the red line being below zero, it would be above zero.
Yeah, no, I agree. I completely agree. We have a difference of figures, yes.
Well, it's not just a difference of figure. It's a difference of how what one takes away from the chart. If you put Mr. Hutchings' figures in red instead of your figures in red, well, the risk adjustment 1% or less than 5% in the last 25 years or 35 years, that doesn't work to the advantage of the Anishinaabe, does it?
No, it gives everything a smaller weight that if closer, whether it's positive or negative, it gives it a smaller weight. Yes.
And you would agree with me that in your slide deck, you said that it reached 1% in 2020, but that was an error. It's actually reached less than 1% in 2019, correct?
I don't have these numbers in the top of my head, but I take your word for it.
I take it that I imagine Mr. Smart prepared the slides where you identified that it reached 1% in 2020?
Yes.
And on the stand, my recollection is that Professor Smart corrected himself and said it's actually 2019, which is the year that Stiglitz and Hutchings also came up with.
Okay.
So let's just accept for a moment it's 2019. That means that in 2020, it's less than a 1% share, whether it's positive or negative, it's less than 1% share. And I'm just wondering, your model would relegate, am I correct in understanding that your model would relegate the Anishinaabe to a 1% share about a 1% share in 2019, a lesser of a share in 2020, is that correct?
Yes.
And it'll continue to go down by 2.7% every year into infinity. Is that right?
According to our fourth option, that's not the only option we present.
And
that's a consequence of risk adjustment. You're right.
But that's the preferred option.
Yes.
Sorry, go ahead.
By us, not necessarily by.
Right, your preferred option. Thank you.
And the court, in its judgment, talked about responsibility, renewal, reciprocity, and respect. Yes. And is it your view that that model that affords 1% from 2019 and following is in accordance with those principles?
We haven't said anything about what the situation is going to be after 2020. There may well be a renegotiation. That's what renewal is all about. You could easily have a renegotiation of the treaty in 2025 or whatever, whenever you think, and then whatever happens from that benchmark rather than from 1850.
And do you know anything about, you know something about bargaining theory, I take it? Yeah. What happens when you have unequal bargaining power?
I don't interpret the starting afresh in 2025, starting from a position of unequal bargaining power.
So you would let me fairly put it to you this way. Is it your understanding then that for the future, those negotiations should take place as though the transaction in 1850 had never taken place and that the Anishinaabe still have unextinguished Aboriginal title? Would that level the playing field a bit?
I don't have an opinion on that.
Oh, so that's not what you're suggesting. No. I want to turn to one of my last topics. And I think I'll go for another 10 minutes. I think there was a request to break at 3:30. So someone will remind me if I start going over, but you understand, sir, that Stiglitz and Hutchings formed the opinion that the income gap data that they used was a good proxy for measuring the wealth gap?
I think that's what they said.
Now, I understand that you might disagree with their opinion, but would you agree with me that their approach is a reasonable approach an economist could take?
Not for answering the instructions that were given to them.
Why do you say that?
Because the instructions were, I thought, said that they should look at the wealth differential between, I forget the words that were used, but I interpreted them as meaning the existing beneficiaries and the, whatever the word there was for the settlers, I'd have to look at the exact wording, but I read the instructions that were given to them as saying you should calculate relative wealth differences between two parties, and I interpreted what the two parties would be those that existed today.
Okay, that's fair. So I'll have to deal with this by the way of a hypothetical. The hypothetical is that the court's direction was not to limit the inquiry about wealth gap to the existing cohort of people alive today, but to take into account the whole period from 1850 to present of gap. Now, if we assume that that's what the court intended, and it's only a hypothetical, I'm putting to you, would you agree with me that their opinion on using the income gap as a proxy for measuring the wealth gap is a fair approach that a reasonable economist could take?
I wouldn't agree that the income gap is a proxy of the wealth gap. No.
Perhaps we can go to Stiglitz and Hutchings' opening report at paragraph, I think 182. I'm going to read some statements and see if you agree with them. So we're at, let's see, hopefully I've got it right. So we are looking then at Exhibit 3. You probably don't have that in front of you.
I don't think I have it, but...
So I think what we're just going to do is bring it up on the computer screen.
Okay.
So Exhibit 3, page 182 and following. What? I've got, oh, I don't know. I've got Exhibit 3 and Exhibit 4. This will help me out. Oh, okay, let's try again. You know which exhibit number it is? Is it 3 or 4? All right, it's exhibit 3 indeed, and we're looking at for paragraph 182, page 88. Thank you, Ms. Lewis. And so Professor Stiglitz and Mr. Hutchings write as follows at paragraph 182, and I'm wondering if you agree with this. They say a standard starting point for well-being in economics is household income. Do you think that's a fair statement?
Yes.
They then go on to say this is not to say that household income captures all measures of well-being. Do you agree with that statement?
Yes.
They then go on to postulate some of the things it doesn't capture. It does not capture the well-being and quality of life that comes from having a political voice, social connections, access to healthcare, a healthy and safe environment, and the non-pecuniary benefits of employment. Do you agree with that statement?
I think so.
The next statement that they state is household income is correlated with educational attainment, employment, and health outcomes, both mortality and morbidity. Do you agree with that?
Yes.
And so just to make a point on that, in terms of mortality and morbidity, the idea is that people who are less well off actually live shorter lives.
I agree.
And the difference between historically, between Aboriginal people's lives and non-Aboriginals is rather profound, and that's a pejorative, but at some point, I think in the data, it shows 11 years not too long ago was the difference.
Conceivable.
Pardon?
Yes, it's certainly conceivable. I don't know the number off the top of my head.
All right, well, it's somewhere in Mr. Hutchings,
yes.
Mr. Stiglitz's report, the data is shown. They then go on to say household income is also widely studied. Would you agree with that?
Yes.
And they also say data tends to be more readily available than for other measures of well-being or quality of life. Would you agree with that?
Yes, so I'm not sure that I could make a comparison between household income availability and health outcome availability, but it's certainly available.
All right. Thus, household income is a useful proxy for measuring well-being, albeit an incomplete one. Would you agree with that?
Yes.
Stiglitz and Hutchings then continue on at paragraph 183. Given the nature of the deprivations here, household income likely understates the true difference in well-being because the disadvantages resulting from differences in income are both interrelated and compounding, with disadvantages arising in other dimensions like health, political voice, and educational attainment. Would you agree with that?
Yes.
At paragraph 184, Professor Stiglitz and Mr. Hutchings say, we note that household income is a flow measure while wealth is a stock measure. Do you agree with that?
Yes.
The next sentence they write, put differently, income is how much money flows into a household account each year, while wealth is the accumulation of the portion of past incomes saved rather than consumed. Do you agree with that?
Largely, yeah.
What don't you agree with in that statement?
Well, you have to take away from wealth that's run down for, I mean, I'll agree with it if you, that's fine with me. I don't have any.
All right, thank you. They then opine, as such, wealth and income are correlated, but not perfectly so. Would you agree with that?
Yes.
They then opine, for our purposes, the difference is likely to underestimate, sorry, I'll try again. they write, for our purposes, this difference is likely to understate our estimates because wealth inequality tends to be more extreme than income inequality. Would you agree with that?
I agree that wealth inequality is greater than income inequality.
Thank you. At the bottom of paragraph 184, they opine the accumulated difference in wealth will almost surely be greater than the differences in incomes. Do you agree with that?
Well, that depends what you mean by the differences in income. Which difference in incomes are we talking about? Are we talking about the cumulative difference in incomes, or what are we? It's an ambiguous statement, I would say.
All right, so let's move on. You opine in response to Stiglitz and Hutchings' approach that their approach leads to some double counting, right?
Yes.
You have not actually looked at their data to estimate the overcounting you allege, have you?
That would require estimates of wealth rather than income.
Would you agree with me, sir, that, and maybe we can put some rough edges around this. I agree that economists like to deal with precision. I'm starting to learn that. But would you agree with me that if you try to take into account the factors that you, to try and eliminate what you say are double counting, that the lower bound of their income calculations would still be greater than 126 billion, which is their rent calculation?
No idea.
You have no idea?
No.
Would you agree with me that, you would agree with me that your calculation would, a calculation that tried to take any double counting into effect would have to take into account how much a person saves as opposed to spends in a given year from their annual income?
Well, I think the point is that the source of the double count, the source of the possible double counting is that wealth carries over from year to year. And if you measure wealth differentials in a given year and you measure them again the next year and again the next year, you're bound to be including part of the same wealth in those 3 years.
Right, but you only count the wealth that's taken over into the next year, not the wealth that's been spent on living.
Not quite sure I understand what you're saying, I'm afraid.
Well, if I get $100 for my salary 1 year,
yes,
and I need to use 80 of it for food,
yes,
I put $20 in the bank, and then the next year, your point is, well, you've already got $20 to start the year. You're not as bad off as you were, so you have to take that into account.
Yeah, I wouldn't put it in that pejorative way, but the point is that if your assignment is to measure wealth differences, and you construct a proxy which you claim is a proxy for wealth differences, and you measure those wealth differences year after year after year, my only point is that you're including the same wealth, at least some of the same wealth, year after year after year. Because if you buy a house and you measure your wealth in the house in a given year and you keep living in that house for several years, you can't just add up the wealth of that house year after year because you're double counting to do that.
So we should count the value of houses in wealth.
We could, sure.
We should, though.
We should. We gave both options. It's controversial.
Well, you've just told me that it's important to include in the value of a house.
Well, I was using a house as an example.
And I'm taking you up on that.
Fair enough. If you want to include housing, that's fine.
But is that the appropriate thing to include housing? You've just used as an example I'm suggesting that if you're going to look at housing, it makes sense to me to look at housing.
You know, I don't, the only concern I have is that if you're making comparisons across communities, housing is gonna dominate everything because the cost of housing is much different across communities. So it can be misleading from the point of view of comparing wealth if it's housing that's dominating. But having said that, fine, if you want to include housing, that's fine with me.
Thank you. Would you think that because of the controversy around housing and whether to include it or not, that an income gap approach is more appropriate?
Appropriate for what?
For the judge?
Well, it depends. I mean, what's appropriate to me is the guidance I get, rightly or wrongly, from reading what the Court of Appeal Reasons for Judgment says, and interpretation I get from reading that, and from looking at the, similarly, seems you would think the same thing, because the instructions that went to the plaintiff's experts suggested that what was relevant was wealth differentials between Anishinaabe beneficiaries and descendants of settlers, which I interpret as meaning people that are alive today. That's all.
Maybe I can put my hypothetical this way. If what the court meant in asking to look at differentials was to consider the effect on the whole cohort from 1850 to the present, is there anything wrong with using the income gap approach as opposed to the way that you approached it for the existing cohort?
In principle, no. You could the output gap is certainly a defensible way for measuring, as Professor Stiglitz and Mr. Hutchings says, well-being. Whether it's also appropriate for measuring wealth and needs is dramatic, because that's what the Court of Appeal said. You know, I'm not taking a negative view here. I have a lot of trouble with what we're supposed to be doing here, because my interpretation from reading, rightly or wrongly, from reading what's in the Court of Appeal is that we're supposed to be taking wealth differences and needs into consideration in judging what share of whatever it is we're sharing should go to the RST Anishinaabe and what should go to the Crown. That's the way I approach this
problem. I've gone over 3:30, and my apologies.
My fault.
Time for a break.
Okay, just let me catch up with this last point, please.
Order all right?
Organizing, you may be seated.
Professor Bodway, before the break, we were talking about wealth differentials. And you would agree with me that Professor Stiglitz and Mr. Hutchings only looked at disparities starting in 1872.
Yes.
And the fact is that in their model, they've not counted income gap consequences between 1850 to 1872 for 22 years.
Yes.
And they have not counted the compounding effect of that income gap differential for those 22 years, correct?
Agreed.
So that's a conservative thing that they've done. You'd agree with that?
Yes.
And if we turn to your approach, the most fundamental difference, as sorry, maybe I should rephrase the question. One of the fundamental differences between you and Professor Stiglitz and Mr. Hutchings is that you confine your analysis to the current cohort who's alive.
That's right.
And then, as we discussed yesterday, I believe, of that cohort, you only include in those individuals who are registered as annuitants.
Who claimed annuities, yes.
Who claimed annuities. And you arrived at a figure of 2,323 families.
Yes.
And you estimated 2.6 people per family.
Yes.
And so I had said yesterday in my faulty math that it was under 7,000. It's actually just over 6,000.
Yeah, I did the calculation myself. I agree with you.
Yeah. And so that's a far cry from the 13 or 14,000 approximate people that actually are treaty members of treaty beneficiary bands in RST.
According to the Big NAMI calculations, yes.
Well, according to Canada's data.
According to Canada's data, yeah, I'm sorry, yes.
Yes. Now, in your model, because of what you believe to be the Court of Appeals direction, the way you understood it, everyone who passed away prior to 2019 doesn't get any compensation. Is that a fair way of putting it?
Yes, we only included the annuitant families in that year in 2016, yes. Mm-hmm.
Oh, in 2016 was your year. Yes, I apologize. Yes, you're right. And you've assumed that it's an are you assuming that it's an individual entitlement in your calculation, or did you just use the individual data to sort of come up with a global collective amount?
There was nothing nefarious in our calculations, translating our wealth differentials into per capita terms. That seemed to be the easiest way to compare between the RST annuitants and the off-reserve Ontarians, let's put it.
Right. So there's nothing nefarious or wrong in sort of expressing it as a per capita basis for the purpose of trying to figure out what the gap is that you think is relevant.
Yes, I wouldn't say that it's what well, I guess it is what I think is relevant. It's what I took we were not given instructions on this particular calculation, by the way. We were sort of going by the way we were interpreting what the Court of Appeal had said, which turned out to be a little bit different than the way in which Mr. Hutchings and Professor Stiglitz and Mr. Hutchings did.
And your approach, let's take someone who suffered a lifetime of poverty up to 2015.
Yes.
Let's take a family who suffered a lifetime of poverty up to 2016, all of whom passed away before 2015. In your model, no compensation is taken, or I shouldn't say compensation, no, they don't figure into your calculation, the losses to those people.
They don't figure into our per capita calculations, that's right.
Right. Now, your calculations as well also assumes that no money would be paid collectively and held invested by the bands. Is that correct? Because you express it on a per capita payout.
That wasn't the intent. The intent was to take whatever the present value owing, whether it be the present value of NCRRs or annuities. In fact, we use annuities. And calculated what that would translate into in terms of wealth per capita, just as a way of comparing potential wealth per capita. In other words, if they had taken that money and held it as wealth, that's fine. We didn't make any prejudgment about what they would do with it.
Right. And the way you expressed it in your slides, it made it sound like you were pointing out, look, if you pay out all this money, everyone's a millionaire kind of pejorative statement. You never intended that.
I can see why you're saying that, but that wasn't the intention.
And indeed, like a wealth fund that's only going to live off of income, you might take a different, might you take a different view in your opinion of what's appropriate if you were told to assume that whatever was awarded by the judge, most of it is going to be going into a fund for the future?
I think we're agnostic about that. We were simply saying, I mean, part of this is a reflection of a great deal of uncertainty on our part about what the guidance was that the Court of Appeal was suggesting. And so we did our best to come up with a figure of how the present value of either NCRRs or annuities would translate into an equivalent wealth per capita figure. And I guess the purpose for doing that was to make a comparison between that and what the wealth per capita was in the off-reserve Ontario population, to see if there's any sense in which wealth inequalities would be equalized by making these payments.
When you do your analysis, we're just changing topics now. Okay. When you do your analysis of wealth, in which you deal with household wealth, yes, you suggest that what should be used is the median, and Hutchings and Stiglitz opinion is that if you're going to go that route, you should be using the mean or the average. That's a difference of opinion between the two of you?
Yes, we present both, but we would prefer to use the median over the mean, but we present both. All
right. And are you prepared to agree that whether you use the median or the mean is dependent on differences of opinion that economists could hold on this subject?
Yes.
And I'm going to suggest to you that using the average for the purpose which the judge needs to use it for, which is to capture what, sorry, I'm going to rephrase that, try and break it up. If you assume, and I'm asking you to assume for a hypothetical, that what the judge is tasked with capturing is the loss to the collectivity of the First Nations, not individuals, then the use of the mean as opposed to the median is a better metric. Would you agree with that?
I think it's a better metric to apply to measuring the wealth of the Anishinaabe. The reason for being cautious about applying the mean in the off-reserve Ontario population is that the mean is, the distribution of wealth is highly skewed. But, you know, I'm not going to make a big deal of it. I'm perfectly happy to go with the mean.
You also remove housing as a component of wealth, and Stiglitz and Hutchings disagree that doing so properly captures the wealth disparities that the experts are each trying to capture in their own way. You agree with that?
Yes, but we also give calculations both with and without housing included.
And you've indicated that earlier on today that it might be appropriate to use housing, include in housing in wealth calculations, right?
I can see the argument for doing that, yes.
Yes, thank you. Just on the point of housing wealth, we included in the article you relied on in, I believe, your slides. I don't know which slide it is, but the article itself is found at tab 9 of the compendium, Exhibit W, page 48, entitled Housing Wealth Isn't Wealth. And I'm going to suggest to you that what this article is about is not that you don't take housing into account in using in calculating wealth, but that housing wealth is not a good indicator of consumption. Would you agree with that?
Yes.
Thank you.
Assuming you're not including in consumption, consuming the services of housing, but that's another matter. Sorry, that's a subtle economic comment.
Yeah, that was an economic joke.
But it wasn't a joke, actually, no. It's a big issue in economics about whether you include the user value of housing in income statistics. It wasn't a joke.
Okay, but in terms of what the judge has to decide here, the point I was trying to make is that the article isn't about not counting housing as wealth. It was about how housing wealth doesn't necessarily translate into increased consumption. That's the point.
I'll accept that.
And if you could please go to page 88 of tab 9. Sorry, perhaps we should go to page 87. Page 87 is a recent article, recent October 5, 2022, written by someone by the name of Beata Karanak, Senior Vice President and Chief Economist of TD. You know this person?
My reputation.
What is their reputation?
This person is the chief economist of TD Economics, which is a reputable research organization, part of the TD Bank.
Okay, thank you. And do you know Francis Fong?
I know of him, but I don't know any of these people personally.
Okay, these authors say at page 88, just bear with me, page 88 in the bottom third of the page, they say wealth inequality in Canada is not just a story of rich versus poor. It is one of homeowners versus non-homeowners. The average net worth of homeowners born between 1955 and 1964 is now more than $1.4 million. This is 6.3 times that of non-homeowners born during the same time. Do you have any reason to doubt that that's accurate?
I have no reason to doubt that.
And let's go over to page 92. And on the left-hand column under the heading, wealth inequality is a story of housing inequality. I'm just going to read here. So while the picture does show that wealth inequality So while the picture does show that wealth inequality has narrowed across the broad measures, that picture is thoroughly muddied by low wealth households that are relatively well off within their peer group and the intergenerational effects of home ownership. Would you agree with that statement?
Yes.
And the intergenerational effects of home ownership are, in effect, saying if your parents had good housing, then that somehow translates into a better outcome for you when you're born.
If you mean by good housing located in an area where the house prices were rising rapidly. Yeah. Not necessarily good housing in a depressed area.
Well, what about good housing in a depressed area as opposed to a car? Does that make a difference?
Well, I think cars have roughly the same value. They don't vary by location. Housing values vary by location.
My point is that having a house as opposed to being a renter matters no matter what market you're in. Thank you. They continue, it's too simplistic to define Canada's wealth inequality as one versus rich versus poor. Over time, it has proven to be one of homeowner versus non-homeowner. Would you agree with that?
I haven't read this article, so I don't know where they're coming from, but it's sound on the face of it, it sounds reasonable.
Thank you. Can we turn to Exhibit 62, your response to Professor Stiglitz and Mr. Hutchins? And go to page 11. Exhibit 62, page 11, paragraph 30.
I don't seem to have, unless I'm making.
Well, perhaps we can just put it on the computer for you.
No, I found it. Yeah.
Okay. At paragraph 30, you say, the Stiglitz and Hutchins RHT report treats net resource rents as being the relevant concept for fulfilling the augmentation clause. This is inconsistent with the Court of Appeal decision and the stage 1 partial judgment. I wonder if at times we're talking like two ships passing in the night, because as I see it, there's two ways of looking at this. One is asking the question, how does one calculate NCRRs?
Yes.
And that's the approach that you have taken. You've looked at that. The other approach is to ask the question, what information is relevant for the court to determine what the compensation in the court case should be? Do you understand why that's a different question?
Yes.
And if the question is not what each year's annuity is, but to ask the question, or for the judge to answer the question, what should the compensation be given the failure of the Crown to engage in a process of discussion with the Anishinaabe over the period 1850 to present, that the concept of rents is a fair and relevant consideration for the judge? Would you agree with that?
I don't have an informed opinion about that.
Would you agree with me, sir, that Vidal and Anderson in their report said nothing about investing augmented annuities in the fashion that you have proposed to the judge?
Sorry, would you repeat that question?
Would you agree with me that Vidal and Anderson in their report in 1849 said nothing about investing the augmented annuities in the fashion that you propose?
There was no concept of augmented annuities when Vidal Anderson wrote the report.
I'm sorry?
The concept of augmented annuities wasn't relevant. It wasn't in the air when Vidal and Anderson wrote the report. We're not, so our use of the term Vidal and Anderson wasn't driven by an argument that they said this specific mechanism should be used for this specific purpose. It was driven by simply by a clause that said, here's a mechanism for determining annuities as a result of a transaction involving part of the treaty territory and that the Crown might engage in with the Anishinaabe. So it was the mechanism that we're talking about, not the particular application of it that came out of the Anderson.
Yeah, I'm going to suggest to you the paragraph that you relied on in the Vidal Anderson report does not say anything about how annuities would be used or invested by the Crown. Would you agree with that?
I don't think I said that.
Well,
I was talking about how you would determine, how you might convert a sum of money that's being paid as a way of compensation for the cessation of land, how you would convert that into annuities, and that's what we took out of the paragraph. Well, I think it's page 11 in the Vidal Anderson report.
I don't know that we need to go there. Just a couple more questions and then I'm done. And I think let's go to slide 102. Would you agree with me, sir, that if the Crown had the kind of perfect foresight that you say they would have had in 1850, that if they had read your report prior to it being amended, that's the 2022 version, they would have believed and made their decisions based on the RST territory having a negative $7.8 billion value over time?
I don't think we said anywhere that the Crown would have had perfect foresight.
Would you agree with me that if the amount of the NCRRs believed by the Crown in 1850 to exist in the future was a negative amount, would you agree with me that they wouldn't have entered into the treaty at all?
Well, you're asking me a similar sort of question to what you asked earlier, and that is that you're taking an ex post result and saying that the Crown would have expected that particular outcome to occur. The fact of the matter is the Crown didn't have perfect foresight. It didn't know whether the NCRRs were going to be positive or negative come 2010. So I don't think that question reflects the approach we took.
Would you agree with me that the reason why my question I put to you is difficult is because the parties said that, sorry, the court said, the Court of Appeals said that the parties took a wait and see approach as opposed to the approach that you've used in analyzing the value of the treaty territory?
As I said earlier, we are taking partly a wait and see approach as well. We're evaluating NCRs as they occur, but we're adjusting them by the riskiness that was associated with them in one of our approaches, one of our 4 approaches.
I wanted to thank you for your time. It is almost 4:30. I don't have any more questions for you. The judge might, and I believe perhaps tomorrow another lawyer is going to have some questions for you, but I wanted to thank you for your time.
Thank you very much.
Questions from me? Okay, so who's next?
Mr. Gover probably wants to indicate to the court how much time he thinks he's going to need, and Ontario is probably going to advise you what kind of time they need.
And Ms. Evans has just moved herself into position to speak to the court.
And to hear my commitment, which I mentioned during the break, I intend to be 42 minutes.
Oh my.
Thank you.
But will there be any stick figure charts?
No.
Okay.
And I don't know how long my friend will be, but I anticipate that we'll probably be finished somewhere around the morning break, in which case we can have the case management conference following that.
All right.
What I would expect.
Okay.
Thank you.
Ms. Evans, are you jumping in?
No, I am just moving.
Okay.
Oh, okay.
And Ontario, anything? Do you expect to take any time?
I understand, no.
Okay. Well, it's going to be another hot day, so probably all happy about these estimates of time, and as well, sir, I'm sure you're happy to hear them. Okay, so let's break now. Let's reconvene at 10 and be prepared to meet after we're finished. All right.